Okay everybody, welcome to the Super Easy Forex family video series that I'm about to do. One of the questions I always get asked about is stop losses, where to place your stop loss. This is going to be very important to watch this information because when people are placing stop losses, they wonder why they lose a lot. Okay, so literally here's a trade that I'm in. Okay, and as you can see, I'm up just 3 pips so far because Triple Arrows just came in on the 30-minute. So you can verify this trade on your chart. So typically what a lot of people do, they like to have their stop loss real tight and everything else to the price action. So they'll move it right below the last high, you know, right around here. Because they see, okay, it touched this high and drop, and then they touch this, so maybe they'll consider this candle. So they'll move it up real close right about there, right? And so they keep it real tight, real tight. And so what they're looking at is they're trying to look at how many pips. So that's an 11, basically about 10 or 11 pips on the stop loss right there. So they're trying to mitigate their risk. And I get that. The problem that most traders fail to understand is market makers manipulation. What do I mean by that? Most traders, and I'm going to talk you through this so that you guys can get this concept, because I'm going to do a number of videos of questions that people are sending to me and I want to address it. This will be the first of many. But on this one, we were doing our classroom trading session today, because we do teach classes 3 days a week for our clients. And so here's what happened. I was talking to one of the students who asked a question about this, and I went into a rant and I said, you know what, I need to share this on YouTube so that you guys will be able to see how this plays out. So when you're placing your trades, I'm not going to even go to showing you just that. I'm going to show you from here, okay, and I'm going to talk you through this trade, okay, not the setup itself, but how it plays out with the market makers. Okay, so as you can see from the higher time frame, I'm on the H4. What the market makers are looking at is targeting a certain group of traders, okay, a certain group of traders. When I show you this, your eyes are going to be open. You're going to be like, no wonder I've been losing a lot of trades, even with good setups. All right, so watch this. What happens is that on the lower time frame, the 15-minute time frame, okay, we got our trade in, we have our triple arrows or whatever system you're using, crossing of the moving averages, blah, blah, blah. It doesn't even matter to a market maker. And just assume I'm a market maker. Okay, so I'm going to talk from a devil's advocate perspective. I know that most traders are going to try to keep a tight stop loss, and so they're going to look at the last miniature swing high. See this area right here, it came and then it touched in this area, so this is one area, but then it came and see it retested this little short area. So I'm going to put it right above here and I'm going to keep me a real tight stop loss. Perfect. That's exactly what I want you to do, because at any given time, all it will require is for me to send out one candle like this one here or this one here. But see this candle? See how I wicked? This long candle gave a wick. See, I can wick you, but it'll go the opposite direction, where they'll wick it in the opposite direction. They'll take out your stop loss and then continue the pattern. Okay, that's quite common. Why? Because you're looking at the wrong thing. And you're gonna have to pay attention through this video, okay, all the way to the end. So watch this. I'm gonna go to the higher time frame and I'm gonna show you a mistake that you made. As you can see, here's where the trade is showing an entry. So I'm in on this candle right here. Okay, my dots are showing me right here that this is where resistance was, but also over here on the higher time frame. So I'm gonna draw a trend line right across so you can see this. Okay, right about here, and you can see if I bring it down right there, it's in between both of these points, and you can clearly see here was the last swing high or low. I'm sorry, the swing high up here, the last, well, you know, swing high, swing low, whatever you want to call it, point of resistance on this trade here. Okay, came up, touched here, that was resistance. Okay, right here, you can see these two candles. You see that? It broke through here, but came right back below it. Came up, stalled out, broke up, but came right back down. Touched, came up, came back down, came up, came back down. So clearly this is a barrier area, right? If you look right here, look at where it came out. And you can see why our system gave us our super easy SRs. That's a custom indicator that we coded for our system. And so our super easy SR resistance had showed us up in this area is great. You drop down to the 15 minute or the 30, even the 30 minute, and voila, we got our triple arrows. Pretty simple, huh? You see those red dots? We got it. Cool. Keep watching. Oh, keep watching. You want to see this, how this plays out. Okay. So right here for us, we in the super easy family, we comfortably know what's going on. Because we know not only are we trading patterns and price action and all these different things people talk about, but it's more than just about price action and patterns. It's also a third silent group you have to trade against, and that's the market maker's manipulation. Now, some people who trade the market maker's method, they know a little bit about this, but they don't know all of it, because if they did, they would still not be losing so many trades. So here's what's the problem. When you're looking at it from a shorter time frame, you're being told, okay, put your stop loss about 15, 20 pips and da-da-da. Okay, fine, do it. Go ahead and do that. Market maker still does not care. Okay, now you could say, well, they used the triple, the 15-minute time frame, so you put it above the high 15 or 20 pips here. That's cool, no problem. But if you're talking about holding this trade for a little bit longer because it's just beginning its descent, and you're trying to go for more than 15 or 20 pips, like for an example, right now it's 121 Eastern Standard Time. That means the market has pretty much slowed down. So even for you to go and get your 15 or 20 pips right now, chances of it happening right now is not going to happen. Market is too slow, but the setup is great. So what that means is you might have to hold the trade through the next session or through the next trading day. That means it's going to carry over. Perfect. This is where the market maker gets excited. They begin to rub their hands together and say, oh my, I see money, money, money. So now you have this tight little stop loss. Okay, so if one of the candles move up just a little bit right about here back into this area, okay, and let's measure that so you can see this for yourself. Okay. So if the candle comes back from here and measure back to this area here, oops, excuse me, hold on one second. Give me 1 second. Let me get this little crosshair tool so we can see this together as a family. So if the price moves from where it is now and comes back up in this area here, anywhere up in this area, that's 15 pips. You see that? About 15 or 16 pips. That's basically about 15, 16 pips. Are you comfortable with your tight stop loss? One candle before the market closes, it's going to move back up in this area just in case. May not even hit your stop loss. Doesn't matter to the market maker. I don't care as a market maker, because here's what I'm looking at. Oh my, I see some fresh money sitting there. Okay, because you're trying to have a quote unquote tight stop loss, keeping it tight like butt cheeks. When you see one, you see the other. They're right next to each other, real tight. Okay, good. Here's what I'm looking at. The moment the market closes and transforms over to the next trading day, there's a magical thing that happens called spreads opening up through the next trading day. As you can see right here on the spreads, it's at a 0.4. But the moment the market closes at 5 p.m. Eastern Standard Time and then reopens, this spread can open up as far as 10 to 15 pips. Okay. All right. So watch this. And I've even seen one that went up to 20 pips at one point. All right. So watch this. Remember, you right here, even if the candle comes right back to here, cool. Okay. That's about 12 pips. And these are just examples, but even if you just say, okay, price stays right here, from here to here, all right, you got a 17 pip stop loss. So all it takes is for the market maker to open this thing up by 15 pips or so at the beginning of the market. And of course, it's going to fluctuate. So with the 10 or 15 pips that the market maker did on the spread, then you add out any tiny fluctuation on any candle, you can clearly see why your stop loss keep getting taken out. Because the problem is that you're being taught tight stop loss, hurry up and get, you want to have a lavish lifestyle with tight stop losses and comfortability. I'm going to put on as much as I can on this trade, but I'm going to have a tight stop loss in case I lose. You're already in a bad situation. And let me tell you why. Let's break it down. Okay, let's break it down. What happens is this. And I'm going to go into the psychology of the market makers, why they do what they do. And they love targeting. All it takes is one candle like this one to take you completely out the game. And then what's going to piss you off because you come back an hour, a couple hours later, and the thing actually went in the exact direction you knew. So let's step away from the charts. Let me talk you through how it works for the market maker. Okay. So for the market maker, what they're considering is that it's a psychology game, not a trading game. So while you're looking at patterns, charts, indicators, and everything else, they're looking at the psychology of their clients. And right now, all of a sudden, we have nowadays an influx of new traders into the Forex market. And so they don't really care about trading the higher time frames. So they don't know what to look for. They don't see all this up here saying, well, putting it above here would be safer, or even a little bit higher, because if this was the retest area back here and it came right back up to this area and this area again and again, then wouldn't it be smart to put my stop loss not right here, but put it a little bit right there? Okay. Now, if I'm over leveraged and I got too much on the trade, wouldn't it be smart to just simply reduce the size of your position, but then you're increasing the probability of having a winning trade without your stop loss being hit? No, that doesn't work for this new generation of traders. You know why? I'm going to tell you why. And this is deep. This is real deep. If you ever look at professional traders, now, a lot of the professional traders who's old school traders, you'll notice they talk about they typically will trade off not the 15-minute or the 5-minute, whatever. You'll hear them talk about that they trade off of the daily time frame or the 4-hour time frame. Even when they're doing their analysis on YouTube, you'll notice that they're doing it off of the higher time frames first, and then they drill down to the lower time frame for entries. Okay, you will see that all of the time. The reason why that is happening is because they understand that not only do I have to consider the price itself and which direction it's moving, how it's working out, but I also have to consider who's my opponent on the other side of the game, which is the market maker. Now, I know many of you guys have taken the market maker's method and things like that. I'm just taking it a step further so you can see why, even though you know the market maker's method, why are you still losing? It's because you're not considering the higher time frames of what's going on, and and they're playing this game with you because they know that this is what's the generation that's going on. The old school traders, and I want you to follow me on this all the way to the end, because it's going to change your life in trading. The old school traders, they already know this, so that's the reason why they typically like to trade from the higher time frames. That's just what they do, okay? Because they know it's safer. The higher time frames absorb market maker manipulations. It also absorbs news events much better and things like that. So in case you're not around, your trade is still safe, okay? Now, in addition to that, here's what's also the problem. And the market maker, me, Mr. Market Maker, here's what I'm thinking. Okay, I got this new group of traders who came in thinking they're going to make a lot of money. How did they get that information? Well, they've been searching on YouTube. They've been looking at YouTube, seeing all these flashy guys with these flashy Lamborghinis, these little mansions, and they making it rain with the money and all this different stuff. Oh, yeah, I see all that. So that means they want that quick, fast money. All right. And those people who was doing those videos, they're showing that they make it $7,000 in 5 minutes, $10,000 in 15 minutes, and so forth. All right, perfect. So if that is the case, what time frame, if you as a market maker manipulator, what time frame would you target to manipulate? Will it be the 4-hour and the daily time frame? Absolutely not. Of course, that's ridiculous. Why? Because it's going to take way too much time for you to do that. So this new generation who wants everything quick, fast, and in a hurry, they're going to typically be trading off of what time frame? Though you got it, the 1 minute, the 5 minute, and the 15. Okay, you follow me on this, because we do have strategies for the short-term trades, but even that, we're very cautious on it. We have a specific time when we enter into it, everything else. So I don't have a problem with the shorter times. It's just you're not being taught how to correctly analyze the market. You're looking for patterns and this and that when you're not looking at the real thing, the real culprit who you really need to be paying attention to. Okay, but keep on going. Let's keep going. So now, knowing that you want fast money, I'm going to manipulate the shorter time frames. So what I'm going to do, I'm going to toss out one of these kind of candles like this one here. See, on the higher time frames, you can see the whole story. You can see exactly what's been going on. Wick candle right here, took somebody out, shorter time frame, and then dropped on them. Right here, wicked on them, took them out. Wicked on them, took them out. Wicked on them, took them out. All this is happening on the shorter time frames over and over and over again. But on the higher time frame, you see it never broke the pattern. It never broke it. Never broke it. Never broke it. Come back, retest, but it's coming right back to this zone. See, you can see everything that's going on, but on the shorter time frame, you don't see this. And so now you got all these hot shots coming in. And now what happens is you put in $100 into your trading account, trying to flip it into $1 million in 2 months because you've seen that done in the video. Oh, good, good, good. So I know what you're going to do. You're going to over leverage your account on this short time frame. Yeah, that's what you're going to do. You're going to over leverage. Okay. On this setup right here, you're going to over leverage your account. You're going to put everything on this one trade. And then you're going to try to keep a tight stop loss to protect yourself so you don't lose your everything, because you want everything, but you don't want to risk hardly nothing. I'm going to say that again. You want to make everything, but you don't want to risk anything. So you're going to keep a real tight stop loss right here. See this candle right here? You see how that one worked? Boom, got him. So all the people who thought it was going to keep on going, guess what they did? They sucker played them. Boom, took them out and then dragged on the other way on them. See how they did that? But see, on a higher time frame, this wouldn't have mattered. But on a lower time frame, see how they targeted all the buyers, the people who flushed in that extra money saying, oh, this thing going to keep on going up. Boom, took them out and drop the market on them. Now you can see this on the shorter time frame, but the problem is, and I know market makers, I know you get this, but the problem is, and the ones who learn the market makers method, I know you learned it on this, but what you fail to realize is even in this arena, when it hits certain seasons or sessions, like the quote unquote London breakout and all these other things, they're still going to do this even on your trade too. So while you're counting level 1, level 2, level 3s and all these different levels and stuff like that on a shorter time frame, the market maker is still knowing that you didn't see this right here, that the price can actually come all the way up to here, not just to here. You see what I'm saying? And then they open up the spreads and they play with you because they know you want a lot of money real quick. And so they're targeting the shorter time frame players. And there's nothing wrong with playing the shorter time frames. We play them all the time, but we have a bird's eye view of what's going on the bigger time frame, so we understand how they're playing this game. So now the market makers have taken you out. You put money back in every week. You're putting money back into your account over and over and over again. You're constantly replenishing your account, but you never thought to replenish your understanding of the market. So your tight stop loss is purposely, look at this, purposely being targeted on the shorter time frame because you have it way too tight. And because of your tight stop loss, you're not leaving room, breathing room for them to go ahead, do their little playing around, and then you understand what direction it goes in. No problem at all. They got you. Let me show you another trade. One more example. Okay. Because this was one that happened, and we discussed this one in the group. And what was nice, because one of our students in the group, we call them teammates, one of our teammates in the group had called this trade out right here. And let me pull it onto the screen. Okay. So you can see this. All right, let me unlock the auto scroll and bring it over. So right here in this area, and I'll mark it for you. Let me insert a little X marks the spot. Right here is where we initially saw the setup, right here. Okay, change that color and let's make it yellow or white so you can really see it. Okay, so right here in this area is where we initially saw the setup. Okay, right here up in this area, we saw the setup. And it was cool. It was nice. Everything was pretty. Everything lined up. Problem is that because it was before the Asian session, guess what the Asian session did? They went and I told them in class, I said, I see a great setup. Let's just be patient. Let's just wait. Don't go too heavy in it because, no, that's not what I said. Let me rephrase. I said, no problem with the setup, but make absolutely sure that you do not have a tight stop loss. I said that over and over and over again. Those who listen, look what happened. Watch what happened. As soon as the Asian market had opened, price was right here. Everything looks great. But then the Asian market opened and look what they did. They pushed the price up by what? 13 pips. Now, some of you guys who having these 10 pip stop loss, you just got taken out. And they knew that. So they took you out with a 13 pip additional stop loss. And then voila, guess what happened? Price literally stopped. And what you see, and our system told us right before the Fed interest rate announcement where the market was going. So look, because we knew don't have a tight stop loss, look what happens right there. So our stop loss not only absorbed the market maker manipulation, but it also absorbed the spreads at the end of the trading day, because we held this one for a swing trade. So that spread that opened up to 10 pips plus the stop loss and all that kind of foolishness they do, we was able to absorb that. And then look what happened. the reward was an additional 13 pip manipulation, and this dropped for over 100 pips right here from Fed announcements. So as you can see, you're always going to end up in a, I can't say always, but I would say the majority of the time, if you're honest with yourself, a lot of your losing trades was because your stop loss was just too tight. And while you're looking at having a tight stop loss, the market makers were looking at being happy that you did, because all it takes is one of these little candles right here, or a little small, like additional 10 or 12 pip move to push it a one step higher of price before dropping it in the direction you knew, and they got your money. And now you're out of a trade, you're frustrated. Now you got to put more money in your account when all you have to do is just give it a little bit of room, even if you have to reduce the size of your lot to accommodate for the stop loss. So in closing, here's what I would suggest. I would suggest that if you have to make a decision by how much you want to put on a trade, because I want to make this money, versus how safe should I keep the stop loss, you never compromise your stop loss just to make more money. Your stop loss is more important than the lot size. Reduce the lot size to accommodate for a decent stop loss, or else, even though you're right, you could end up on the wrong end of the trade, like right here. Okay? All right, hopefully this helped.